Frontline stocks trade range despite strong gains in the US equities. Mid-cap shows some green. Realty and IT are the significant gainers, while FMCG and auto drag.
Bharti Airtel perks up on hopes of a tariff revision later in this year. Apollo Tyres climbs as analysts take note of debt reduction efforts. NCC shares also rise on strong growth guidance, while Somany Ceramics jumps on sharp rise in margins.
M&M clocks 50,000 bookings in 60 minutes on the launch of its compact SUV XUV3XO. The company says 10,000 units are already in stock and its facility can produce 9,000 units every month. Deliveries will start from May 26.
In a rare and exclusive conversation, D-Mart CEO Neville Narona says that digital commerce is the next big challenge and the sudden disruption of general trade needs to be keenly watched. Adds growth in Tier 2 cities and beyond is a multi-decadal opportunity, and new store additions and looking for moats in e-commerce is on top of his mind. Good afternoon. You're watching us here on Halftime Report. I'm Manglam Malu. With me, as always, Ekta Batra. The market facing nervous 90s, so to say. Once again, at a high a little over 22,300, the Nifty gave a bit of a sell-off and now holding around that 22,175 mark. So, all in all, a range-bound volatile market, which was earlier buoyed by the sentiment that came in from global markets, lower than expected US CPI, and now it's back again nervous on account of developments in the Indian markets itself. However, the heartening fact is that the mid-cap index continues to outperform with almost 0.4% gain on that index. Ekta, hi.
Hi, Manglam. Yes, absolutely. You know, we haven't been able to take forward the global cues and the benevolence that the global markets have been showing. And that seems to probably also, a little bit of a concern comes in from the FIIs, which have been continuously selling through the month of May. I think they've sold over 35,000 odd crores. It's a continuous selling, not one day of a buy figure from the FIIs. So I think that is also probably a point of concern that the street is watching out for. Just want to get the elections out of the way. But nonetheless, like you mentioned, the mid-cap index has been outperforming. And on a week-to-date basis at current reckoning, it's up around 3% odd. So good going for the broader markets. Let's see whether that sustains or not. But let's put the focus on Q4 earnings of Kalyani Steel. The company reported what was a mixed set of numbers. The revenue jumped 9% on a year-on-year basis, while the EBITDA margin contracted. To discuss the demand and pricing trends, we have with us R.K. Goyal, the MD of Kalyani Steel, is now joining in. Mr. Goyal, thanks very much for taking the time out. Well, it's been a marginal growth of around 5% Q-on-Q in terms of revenue. Growth has grown 9% year-on-year as well. How much of it was price related this time?
Good morning. First of all, the growth is largely related to little bit increase in volume. However, definitely the margins are lower. As I mentioned in last interaction with you people, we were expecting a price increase. Till now, that is not settled. And hence, definitely it has an impact on profitability.
All right. So you said that, the last time you were engaging for a price increase from OEMs, you were looking at roughly 3,000 rupees in terms of an addition or a revision. Just wanted to know, did that happen in the fourth quarter, the first quarter? What's the outlook? And are you satisfied with the kind of outcome of that negotiation?
We are definitely not satisfied. There was an increase of only 750 rupees from some and little higher from some others. But we were expecting, as you have rightly mentioned, around 3,000 rupees. Those discussions are still on, and let's hope for the best. Maybe we will get from 1st of April the next increase, and that will definitely improve our situation.
How much do you think that would be? Because what's the future course of action?
We have asked for 2,500 rupees. We are expecting that to be through.
Oh, okay. So you are expecting 2,000, you're asking for an additional price hike of 2,500 odd rupees. You're expecting that to probably go through. By when will you probably manage to implement that?
You know, when you are in negotiation, that situation is dependent on two parties. So we like to have it today, but then it is not 100% in our control. Definitely, our customers are listening to us, and let's see how fast we can do it.
Okay. All right. Fair enough. Well, your earlier price hike was 750 and you had anticipated 3,000 odd rupees. So it'll be interesting to see what you come up with this time. But nonetheless, your margins, you earlier stated your guidance was 18 to 22 odd %. You've done around 19% for the entire fiscal. Tell us, what is FY25 looking like?
Steel industry and particularly specialty steel industry is vulnerable to what is happening in China, how Chinese mills are behaving, which means the prices of all inputs, including coking coal, iron ore, ferroalloys, including nickel, moly, chrome, etc. So we are highly vulnerable to that, and to what extent we are able to pass on to large OEMs. That's another important factor. As far as our manufacturing part is concerned, as far as our yields are concerned, performance parameters in the plant are concerned, we are doing extremely well. And there is another thing which we would like to happen, that some sort of restriction on export of iron ore. Because within India, whatever we are getting, the quality and quantity both are going down. Quality is going down. At the same time, the availability is also going down. So we are taking up with at the appropriate level and would like to see some more restrictions on export of basic minerals, which no country likes to do.
All right. What about, if, for instance, the price hikes don't come by at status quo, what end of the margins would you be? Would you be below 18%, or would you manage to hold on to this 18%, band that you've given between 18 to 22%?
I don't think we can run our industry thinking so negative.
Okay. But, I mean, the street has to price in something, but be that as it may, okay, I won't, push you for the margin outlook. The last time you joined us, you also said that you will give us, an outlook on the ramp up of the Kalyani Steel that you acquired in Jan 2024. Where has it reached? What's the kind of potential revenue here, and what are the synergies likely to be?
It is a part of larger plant, Kalyani Steel. It's a melt shop with a caster, and we are putting up a large integrated steel plant, and it will become part of that. So Kalyani Steel in isolation will not give any additional turnover, but it will become a part of our larger expansion plan, and then it is definitely reducing our project cost.
Okay. So you do have quite a lot of capex coming up. You do have a project in Odisha as well. I think it's around the 5,000 crore project. Can you give us details in terms of how exactly it's going to be funded? When does it come on stream? And cumulatively, what does your capacity go to, and by when?
This project will produce around 0.7 million ton. The capacity will definitely go to by that quantity, and it definitely will take time, because we are in the process of environment clearance as well as forest clearance. All such issues are there, but it's a very unique project, and the majority of the products which will be produced, they will be first time in the country. So we expect things to be much better.
All right. You have the target of reaching to 1 million tons by 2028. I just wanted to know, the funding plans for all the projects that you have. This Odisha project, how much of it will come in from the promoters? How much of it will come in from debt? You said the last time that you will give us all these details. Also, while you're at it, projections for FY25 and 26 for the Kalyani Steel plant too.
As far as this project is concerned, we have not finally concluded how we will fund it, but we have more than adequate equity within Kalyani Steel, and balance can be debt or some other options. We will do it at an appropriate time. Right now, it is a little early. Even bankers have advised us to wait for some time, because EC itself will take a year's time.
Okay. What would be the upper limit of any kind of fundraising that you would consider?
I think we will take a year's time, because we don't need today. Otherwise, we have to start withdrawing.
But what is that upper limit that you probably envisage, or, as a company that you would be comfortable with, say, even if it's a year down the line?
Yeah. So upper limit is in the sense, once we get EC and FC, at that time we will do it.
Okay. And what about any projections on FY26 and 27 on, how the Kalyani Steel would aid your EBITDA? You said that it won't aid your revenues immediately, but because it's a part of a larger plan, I'm sure there would be some cost benefits coming in. What's the current, projected EBITDA for this plant over the next couple of years?
As I mentioned, This plant is part of our Odisha expansion plan. There, it will be, this melt shop will be part of that expansion plan, and it will save us in project cost as well as in time duration. It will not be operating in isolation. So it will operate along with the Odisha project.
All right, Mr. Goel, then let's wrap this up with a long-term vision that you have. Say 2028, you do get to that 1 million, ton capacity with all the things that you've been planning in Odisha and otherwise as well. What would then look like, when we look at your P&L? What would the revenue be? What would the idle margins be according to you?
It's very simple. We will have at least more than 20% EBITDA, definitely. Our manufacturing cost will be much lower. So it will be much more than 20%. And definitely, if you are producing 0.7 billion with the type of product mix, it will definitely increase the turnover by 7,000 crore once we achieve at least 95% capacity utilization.
All right, so we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Kalyani Steels. That stock is in focus, down around 1-odd%. Just want to point out that the Mankind Pharma's conference call is now currently underway. It started at around 12 p.m. So there are some flashes which you should just keep in mind with regards to Mankind. Remember that stock is down around 3-odd% despite a good set of numbers, only because of the hefty valuations. But they have indicated that they are always consistently evaluate a presence into high entry barriers via the inorganic route. For example, they did enter into a licensing agreement with AstraZeneca. They've also carved out an OTC segment into a new subsidiary. So it's just a couple of takeaways. The acquisition part would be something that the street will be watching out for closely, as well as guidance on the export business and the domestic consumer health business. We'll take a short break, but we'll get you a lot more stocks in focus. We put the focus on Somany Ceramics and Honeywell Automation, which are reacting to numbers. Stay tuned. Welcome back. Well, it's going well for the markets. In fact, we now have the Nifty, which is up around 85 odd points. So a little bit of movement, which we are seeing. But remember that we have Asia, which has been extremely strong in today's trading session. We've had the US, which has closed up extremely well. And let's see whether we manage to take those cues forward in a more significant way. But a lot of stocks in focus now. We have Somany Ceramics, which has surged today. This is after reporting its Q4 numbers. Manglam, you're tracking the stock. Tell us more.
Yes, there was a period sometime last year where all these tile-making companies were worried about rising gas prices, and as a result of which, there was an impact on their EBITDA as well. Now, that seems to be coming around, and that's the trade which is unwinding, and which is why we're seeing a big jump in all these companies' EBITDA margins as well. Somany Ceramics is no different. In fact, their revenues grew by about 8.5%. And if you look at their EBITDA, that grew by about 30%. That implied that there was an EBITDA margin improvement of nearly 180 basis points. Where was this led by? The next plate comes up for you, and you will see that the power and fuel expenses of the company from last year have actually decreased. So as a percentage of sales, there's been a delta of nearly 370 basis points, half of which have actually come down to the EBITDA of the company itself, and which is reflecting in their bottom line. But that's not all. In fact, in the fourth quarter, there was some green shoots of recovery as well. Volume growth in the fourth quarter was 7%, and that's higher than what they've seen on an annual run rate of 5% as well. The management is confident of demand recovering going forward, more so from the second quarter, once the election-related disruption is out. And not just that, with stable input costs, the management also is doing a lot of cost optimization strategies, and as a result of which the margins have improved, and this is likely to continue. Not only that, their operating performance of joint ventures have also improved. So they believe that maybe going forward margins will continue to do well. So if the margins continue to do well, all you need is demand recovering. Once the demand starts to recover in the second quarter, as the management believes, then maybe things would look a lot better for Somany Ceramics, and that explains why the street is optimistic about this.
Okay, all right. So that's on Somany Ceramics, stock at around 720 odd rupees. The other one is Honeywell Automation, which is in focus after posting what was a mixed set of Q4 numbers. Sudarshan is tracking the fine print, and fresh calls on the stock also from brokerages. Sudarshan.
So if you have seen the stock move, Honeywell Auto, it had opened with a cut of almost 6%, and from there it made a sharp recovery, and now the last time I checked, it's up almost 6%. So basically it has recovered almost 12% from intraday low. Now coming to the numbers, Q4 numbers, revenue has missed estimates while EBITDA and margin were above estimates. Revenue missed estimates by 4%, but it's up 12% year on year, and margin has come in 200 bips higher at 17.9%. Both margin and profit are at multi-quarter highs. Now coming to the brokerage views, Nomura has come out with a note after Q4 earnings. It has maintained buy rating but raised target to rupees 53,600 from rupees 46,100 per share. And it says revival in real estate, healthcare and hospitality to push demand for building automation, and company is well placed with its holistic offering for renewable sector, and it can provide comprehensive automation for PV cell factories. And considering all these, it has raised P multiples to 60 times from 55 times for sectoral tailwinds, and it expects margin to recover to 15.6% by FY26 from 13.8% that company reported in FY24. So overall, positive earnings from Honeywell Auto, and that's the reason stock is currently up 6%.
Take that point, Sudarshan. Thanks a lot for that. Remember you telling us in the morning that it's likely to be in the green. There's been a big recovery from the lows, but what I'm interested in is the brokerage multiple, increasing multiples from nearly 55 times to 65 times. And here everyone's blaming FMCG for being, extremely expensive when it comes to multiples. Keep an eye on the market though. There's been a stellar recovery from the lows. IT has lifted sentiment right now, and alongside that, the intraday chart of HDFC Bank should come up for you as well. That's single-handedly lifted, the Nifty bank and has had a positive contribution towards the Nifty as well, along with the IT pack. We take a short break, come back, focus on the markets itself. Aditya Agarwala, who's the head research and investments at Invest for Edu, joins in with some trading strategies. Welcome back. You're watching us here on Halftime Report. The Nifty has seen a stellar recovery from the low. So it's an interesting day of trade. Let's see where it goes from here, because at higher levels, we've seen some sell-off as well. So, as the chart comes up for you, it'll tell you that the Nifty has been facing some sort of speed bump at levels a little under 22,300, around 22,300 itself. Because on May 9th, the high on the Nifty, 22,308, then around 22,270 from where we saw a bit of a sell-off. Yesterday was just shy of that 22,300 mark, and today the high was 22,330, telling you that there is congestion between 22,300 to 22,350 as well. And that congestion zone is also marked by a couple of these technical factors, the 50-day moving average on the Nifty and the 20-day moving average on the Nifty. So for the Nifty to see a further recovery, it has to cross past that. And once it does, then maybe chances are that the up move could be a lot higher. Why is that? Because the FII exposure on the short side is at a near record high. 245,000 contracts are on the short side in index futures by the FIs. Their long exposure is just 28%, leaving 72% on the short side. So if the market has to move higher, all of them would have to cover their positions. And this is for the May series. Nifty weekly options expiry today. What are the option writers gunning for? 22,300 call is continuously seeing some writing. Premium of around 11 rupees, telling you not much above 22,300 is where the resistance comes by. But if we do cross that, then maybe all these 3 crore call writers will have to cover their positions. And at the lower level, 22,200 put, which equates to a support zone of 22,150 thereabouts, is still active. About a crore shares out there. So short point, 22,150 to 22,300 is the range that option writers are playing for ahead of expiry today. The market's moved higher. Let's see where it goes from here.
Okay, all right. Aditya Agarwal joins in to discuss the technicals of the market. Aditya, good comeback for the markets at this point. Let's see whether it sustains. But we're finally probably taking a little bit of, cues from the global space. How would you approach the second half?
Good afternoon, Ekta. Good afternoon, Mangalam. Thanks for the show. Markets will remain, I think, choppy in the second half as well. The first half, we've seen choppy sessions. I think it will continue to remain that way. I don't see a runaway rally in the markets. On the upside, as Mangalam had highlighted, 22,300 or 350 will act as a hurdle for the day. I don't see markets breaking that immediately for the day. Maybe tomorrow or next week we can see a bit of a pullback from the market above 22,300 and can test levels of 22,500 as well. The Bank Nifty is the weak link, Ekta, clearly, because it has been underperforming. Yesterday also we saw a bit of selling pressure in the banking index, and today also we're seeing weakness in the Bank Nifty. So 48,000 is something that I'm eyeing very closely on the Bank Nifty. If that is taken out decisively, then there is a case for a fresh long in the banking index, and then I think Bank Nifty can test levels of 48,800 as well on the upside. Overall, I believe markets should see higher levels, not today. Maybe tomorrow or next week onwards, we can see levels of 22,500, 600 on the Nifty, and Bank Nifty again 48,800 to about 49,000. There are pockets which are outperforming. I think that will continue as we are seeing in trade today as well.
Wonder what the market is on right now, because as we speak, it's given up that little bit of a smidge of a rally that we saw in about 15 minutes as well. So the intraday chart, Aditya, should come up for you once again. The Nifty is back again in the red. I mean, it's very interesting. When we started the show, it was around 22,160 thereabouts. There it was a vertical up move that we saw, and that as vertical as that up move was, has equally with equal pace been sold into and back in the red. It's pretty choppy terrain. So how do you play the stocks here, Aditya?
It is difficult, Mangalam. The only saving grace that I see is I don't see a spike in the wicks. That is something which is now moving sideways. So that is hard for the bulls because I think it's more of an expiry trade that we are seeing in the markets, this sharp up move and down move. And it's difficult, you rightly pointed out. But nonetheless, I've highlighted two stocks that can be bought for an intraday basis and can be traded. IT is looking extremely interesting, Mangalam, and Tech Mahindra is something which is the trend. So I think Tech Mahindra is something that can be bought at current levels for a target of 1400 on the upside with a stop loss at 1260 on the downside. The second stock is PFC. Again, this REC PFC, they continue to make new highs and looks very strong on the chart setup. So I think even at current levels, one can get into PFC and look for a target of 485 on the upside with a stop loss at 437. These are two trades, but yes, do watch out for the volatility. I think markets will remain volatile within this range for the rest of the day.
Okay, just quickly before we let you go, I wanted your thoughts on M&M, considering that stock is hovering at record highs.
Ekta, that is one stock which is actually looking good on the charts, and it has broken out from multiple resistances. If I see a dip maybe closer to about 2250 to about 2270, I wouldn't shy away from going long on M&M, and I would look for a target of at least 2400 on the upside. Looks strong. It's going good for the stock. I think it should continue its upward momentum. In fact, the auto pack, I believe, is something which should be very interesting. Look at the way Ashok Leyland is moving. I think there are a couple of packs within the auto space, four-wheeler, especially M&M, I think should continue to see higher levels from current levels. So it's a buy for me, Mahindra, if you see a dip closer to about 2270, 2250 on the downside.
All right, Aditya, we're going to let you go on that note. Thanks very much for joining in and giving us all of those cues from the technical space. Well, definitely a choppy market as we head towards the election result. And that's also indicative in the VIX, which has risen almost 60% this month. We'll take a short break, but on the other side, Mangalam will bring you some key takeaways from my exclusive conversation with the Avenue Supermart CEO. Stay tuned. Welcome back. Well, let's talk about one stock. Our colleague Mangalam had an exclusive chat with the Avenue Supermart CEO, Neville Narohana. Mangalam is standing by at the wall with a few key takeaways from that conversation, that exclusive conversation. Over to you, Mangalam.
Well, for a conversation which is so rare, it is important to get Neville Narohana's view on the way retail itself is shaping, because D-Mart's word on that really holds. And the last conversation that I had with him was 6 years ago. And in the last 6 years, a lot has changed with digital coming by, quick commerce, as well as the pandemic in the middle as well. So when we spoke about the structural changes in the retail industry environment itself, well, the word it indeed was quick commerce, where he said quick commerce could have huge scale and digitally enabled micro enterprises can really reach tiny audiences at very low cost. So that's been one structural change in modern retail itself. Over the last couple of years, we've also seen the mix of D-Mart deteriorate away from apparel. So the obvious question was, is it because of the new value retailers that have come to the market, the kinds of Zudio, etc.? Well, he said the impact of value retailers has been specific to a certain category, such as apparel itself, and that explains the sort of impact that, guys like Zudio or others would have had on D-Mart's own apparel sales itself. The assessment of the pace of growth of stores. The street could not have D-Mart adding any less stores. They just want them to keep adding more and more stores. And to that, Neville said that while the external world is tracking how many more stores D-Mart is adding every year, they worry about how well the new stores added are being managed and how they are growing as well. Having said that, they did allude to the fact that they have to add as many stores as possible and as fast as possible. How can that happen? Is there enough real estate in the market? Well, to that he said that digital commerce is actually showing them the way, even in limited real estate opportunities. It's quite clear what digital can do fast. A lot of the physical retailers can't. And on that itself, a lot of the conversation veered around, where he said quick commerce is a significantly smarter format than all the other digital platforms that we have, and a lot more relevant for India, known for leapfrogging technology itself. And on competition itself coming in from digital, he said that digital commerce is the next big challenge for all the modern retailers. In fact, while D-Mart will be able to compete, the sudden disruption of general trade needs to be keenly watched. In fact, that's not all. There will also be a significant amount of digital before modern trade evolves and matures, and as a result of which moats of every business will be slightly weaker than pre-digital times, because entry barriers have actually reduced, and at the same time it could reduce the profit pools for a lot of the retailers as well. The growth opportunity in tier 2 and beyond is what everyone is eyeing. We're talking about the Bharat opportunity, which Neville believes is a multi-decadal expansion opportunity, and they do intend to reach out there as well. Speaking about the key objectives for D-Mart going forward, he added that adding new stores and looking for moats in e-commerce business, which includes the likes of D-Mart Ready, will remain the key focus area for the company.
Okay, all right. And you can catch the full conversation on CNBC-TV18.com. Thanks, Mangalam, for that. A comprehensive takeaway from a very rare interview. In fact, to discuss more on this, we have Biju Kurian, who is the chairman of the Retailers Association of India. He was also the former president and chief executive at Reliance Retail as well. Biju, thank you very much for taking the time out. Well, the big question and discussion is definitely what is taking place with quick commerce. We saw it with Zomato, where Blinkit really stole the show this time in terms of the talking points. What is your sense in terms of the further scalability for quick commerce in the Indian market?
Well, I think quick commerce, if you ask me, is a service which is being provided, largely driving the need for households who kind of run out of groceries, and because of which they actually are using this opportunity to be able to what you call as top up groceries, to be able to buy top up groceries. This, I think, will continue to remain a need because of the fact that the way we buy groceries has also changed over the years. Traditionally we used to buy from large wholesale markets, then we used to do monthly shopping. And now when you look at it, we actually end up buying more frequently during the course of the week. And as long as that happens, then it's quite likely that you will need, a combination of buying from a grocery store as well as having somebody supply to you at home.
All right. Biju, the thing that we want to understand now is that while quick commerce is a big opportunity and everyone's using it, it's still limited to just a few metros. At scale, do you think there's room for more players here, or maybe is it a winner-takes-all sort of market?
Well, it's a high investment category. And along with being a high investment category, it also needs to make sure that you scale. So you could see that even a company like Zomato has managed to scale quite significantly, but despite that loses money in this particular category. So to my mind, if you ask me, I think if you're going to be able to achieve revenues in the region of maybe about 3,500, 4,000 crores, you'd kind of break even with something like this. The second is that it's because it's high investment and you've got the promise of 10 to 15 minutes, you need to be able to use extremely sophisticated analytics to be able to determine where your dark stores need to be put up, and also the amount of investment that you want to keep in these dark stores in order to be able to fulfill your promise. So it's overall, it's a good game to play in. Currently, it's confined only to groceries and home essentials, but there's no reason why this service can't also extend to other categories of products.
So just to take that point forward, because that's the key point, that how much do you think it can expand? Which are these other categories that companies could probably look to invest in and probably have a first mover advantage?
Speedy fulfillment is, I think, an essential consumer requirement. And everybody looks to try and make sure that, if you buy something online, you want to get it at your home as fast as possible. Currently, the only things which demand that it needs to come in there as quickly as possible are groceries, because you require it as part of the kitchen. However, if you're getting something else within half an hour or within a couple of hours also, you still are making a difference compared to what the classical e-commerce players are currently doing. So I think to that extent, you will certainly find that over a period of time, if you go into, let's say, electronics, if you go into things like, electronic accessories, stuff that you need in an office, you need at home, you suddenly realize that you run out of it. Can I check it on quick commerce before I actually order it on even another online place?
If the purchase decision is made, then the only impediment is the delivery time, and it cannot be done sooner. So that we take your point that, once categories broaden out, people would want things faster. We've seen that with cell phones, and even as, recently when the PlayStation 5 was launched, it was launched on quick commerce itself. But what Neville said, that while we'll be able to compete, that is D-Mart, it is the sudden disruption of general trade that needs to be keenly watched. What happens to general trade then? Do all of them turn into dark stores?
Not necessarily. They don't need to turn into dark stores. What the quick commerce players are doing, general stores can also do. If a quick commerce player is creating a dark store, which is essentially a warehouse, and then moving goods from the warehouse to a consumer's home, the close-by general store can also do the same thing, and many of them do it. Traditionally, you know that if you call up your local retailer, grocer, and tell him that, please send a pound of bread across, that's something which he's very comfortable doing. Or your pharmacist and asking them to send medicines across. Now, this is something we don't call it quick commerce. It's something which happens in half an hour, depending on what is the nature of the need. But at the end of it, if you ask me, general stores have the same capability as any quick commerce player. The way in which they do it might be less sophisticated than a quick commerce player, but essentially they can do the same thing.
Okay. Well, for D-Mart in particular, what do you think the company probably needs to do going forward in order to create that moat or to create that USP and sustain earnings?
I'm sure Neville will have more ideas about what needs to be done, but I think if you ask me, digital is an integral part of running a physical business today. There is no way that you can say that I will only have a store and I'll only serve customers in the store. You have to understand that your store is a point of access as far as the customer is concerned. And one way of serving the customer is to have them walk into the store and pick up. The other way of serving the customer is to be able to connect with them digitally and then figure out how to be able to deliver to them physically. So you have to try and see how to translate your store from merely being a location where customers come to also a place where you can integrate a lot of digital technologies and be able to do exactly what a quick commerce player can do.
Final question then, and this is from the perspective of CPG companies. How will CPG companies reset their thinking when it comes to supplying to another channel, when it comes to their price, the range, the assortment that they have to fulfill to all these channels? What is the kind of reset that is required by them?
I don't think there requires to be too much of a difference to what they're currently doing. They currently actually are replenishing stocks at retailers' counters. Retailers have inventory management systems which allow them to be able to actually order as and when the stock levels decline. So to that extent, I don't think there'll be too much of a difference which needs to be made to them. The play will be at the front end in terms of pricing. While delivery might end up becoming table stakes, at pricing levels, you can have some who are willing to be able to burn cash and some who might say that, I need to protect my margins. That's the only area where CPG companies need to be worrying because, the general trade has less ability to be able to offer deep discounts, whereas some of the larger online players can afford to do that.
Okay. All right, Mr. Kurian, it's been a pleasure hearing your views on the entire retail sector in India. I'm sure we'll touch base with you much more in the future to get your perspective on what is a rapidly changing scenario. Thanks very much for joining in and talking to us. We need to take a short break, more on the stocks and back to the markets on the other side. Stay tuned.
Well, choppy terrain for the markets. Indian Hotels is one stock which is holding up in the green, up around 2% has been a big mover because of, the resumption in travel that we've seen. But that's not all. It's also actually launched the world's first Taj-branded residences. The ongoing mixed-use development in Chennai will see the hotel chain partner with city-based real estate developer Ampa Group to build 253 hotel rooms and 123 residences with the Taj branding. So if you wanted to live in a place that looks like a Taj hotel, then maybe this is the place for you in Chennai. CNBC-TV18 learns that these homes will be on sale. How much do you have to pay for that? Anywhere between 6.5 to 19 crore rupees. Completion scheduled for Jan to March 2027. Jude Sanit, our colleague, spoke to Puneet Chatwal of Indian Hotels, and he sees great potential in the business residences segment. Listen in.
We recently announced the launch of a reimagined gateway, and by the time this project opens, we'll also be very strongly in the business of business residences. So I think it's a very thought-through, sustainable, profitable growth model which serves all customer points and is in tune with the time. I think we are in for a double-digit growth for some time, and then it will go to high single digits because of higher rate of inflation in this part of the world. So the ADR has to increase higher than the rate of inflation. And that would be made possible because the supply that is in the pipeline, more than 50% of that, as per Horvath Consulting, is in tier 2, tier 3 cities, where there is not much supply. So your ability to charge in your current 8 metros and 10 top markets is going to remain strong for the years to come.
Welcome back, and joining us on the show now is Rishi Nathani. He's Chief Business Officer at MCX. Rishi, hi, welcome and congratulations for yet another record high in sense of turnover there. Do want to understand on what really has been the growth on a quarter and the yearly basis when we look at these volumes.
So if you see last year, we were doing around 88,000 crores on options on the overall year and around 20,000 on futures. And last month, on April 15th, we did a all-time high of 292,000 crores. And yesterday, exactly a month later, on May 15th, we did 377,000 crores. So the growth has been phenomenal, and we are thankful to all the market participants who are enabling this to happen.
Rishi, is it the futures or the options that is giving you these kind of volumes, or is it simultaneously both of these products doing well?
Yeah, so the growth has been across both futures and options. So as I told you, the numbers in futures were around 20,000 crores. Now, yesterday you saw 36,000 crores. So we've seen an increasing trend in the futures volumes. Options are also growing. So we are seeing an all-round growth across segments, across products, and across participants.
Rishi, and what commodities really seem to be doing well? Because we seem to be riding a wave where almost every commodity is in news for some reason or the other. The bullion has been rising. We've seen base metals do quite well. So where is a major chunk of this volume coming in from?
Yes, so as you rightly said, the growth is all round, and we are seeing every segment showing a lot of interest from market participants, be it hedgers, be it prop traders, be it investors, everyone. We are seeing a lot of interest. The bullion segment is very vibrant right now, and so is the base metal segment. And of course, the energy segment has been vibrant since a long time. So it's very heartening to see that a lot of participation is coming across the board, across various market segments, and across products.
Rishi, also, when you talk about participants, what geographies really seem to be doing well? Are you adding more participants? Are more people registering in for commodities with the kind of run-up and the kind of moves that we've seen in the asset class?
Sure. So we are seeing participation from across the country, and every nook and corner of the country we are having participation, and we are seeing a very strong interest in commodities. Anyways, commodities is an integral part of our lives. Everyone understands commodities better than anything else. It is just they need to understand the connect between those commodities which they're using on a daily basis to these commodity derivative markets and how they can benefit from these. And that is why we are seeing, with increasing awareness, with increasing outreach by the exchanges and with various other platforms, we are seeing a lot of interest from market participants to access these markets and benefit from them.
Rishi, for some time now, we haven't seen a new commodity come on board. So are there any plans in pipeline? Are you looking at more products, more commodities to add to the list that MCX boasts of right now?
Sure. So we always keep working on commodities. It's an endless process, and as and when we find something which is palatable to the market and it is required by the market, we'll definitely seek regulatory approval and bring it onto the platform. Having said that, of course, we recently launched the crude oil mini and the natural gas minis, which both options which are both seeing very good participation. And as regards the new commodities, especially the new list of commodities which SEBI has allowed, we are working on that list as well. And as and when we see within that list or outside that list, we will definitely approach the regulator and seek approval and then bring those contracts to market.
All right. As a market, definitely watching out and waiting for that, Rishi. And congratulations yet again for those very stellar numbers there.
Thank you.
But with that, that's all the time that we have on Halftime Report. Business Lunch will take all the action forward.